We are watching massive deleveraging events ripple through the system. Markets drop out of nowhere, and panic triggers severe international tech sell-offs, like the 40% rout we saw hit South Korean retail traders. Immediately, major institutional warnings follow. Bank of America issues alerts that their strongest sell signal in years has just been triggered. But then you flip the channel, and elite analysts like Fundstrat's Tom Lee are looking at the exact same market, seeing a coiled spring and projecting massive bull runs and record highs by 2027. As a retail investor, this creates a punishing level of cognitive dissonance. Your portfolio is bleeding, yet you are being told simultaneously to run for the exits and to prepare for a historic boom. This confusion doesn't happen because one side is wrong. It happens because financial media constantly combines two entirely different operating systems into one unified feed. Here are your options: trade your time or emotional endurance. Bottom right is macro endurance. Driven by fundamentals you hold for years with zero daily effort. Top left is micro opportunism, driven by technicals, demanding intense, active daily effort. A technical trader and a macro investor can look at the exact same CPI report or earnings drop and extract completely opposite, yet mathematically correct, actionable advice. Your financial survival depends entirely on looking at your personal constraints, your actual schedule and risk tolerance, and matching them to the correct side of this chart. The macro approach relies entirely on underlying economic drivers. When housing prices decline for months and wage growth moderates, macro investors see cooling inflation and a coming shift in Federal Reserve policy. The expected outcome here is capturing massive multi-year recoveries. You ride out major structural shifts in the economy, and you do it without needing to monitor a single intraday price fluctuation. This table outlines exactly what is required to successfully run the macro endurance strategy. Your input is a blind commitment to your long-term thesis. You must completely avoid opening short-term charting tools or reacting to weekly red days. The primary trade-off is the immense psychological pain. You have to watch your portfolio sit upside down during 10% structural drawdowns, holding through long stretches of dead capital. Within this framework, a sudden AI sector crash or a massive hedge fund deleveraging event is viewed simply as a coiled spring, not a reason to sell. Macro endurance reliably generates wealth, but only if you possess the sheer emotional fortitude to do absolutely nothing during a crisis. Now shift to the technical trader. For them, global economic news is secondary. Their reality is dictated entirely by 2-minute charts, strict support levels, and immediate price action. It is an environment defined by relentless pace. You are competing against algorithms and high-frequency flows, reacting instantly when trend lines break. If you hold a mega-cap stock like Tesla, you can experience 5 to 7 years of effectively flat returns, even while the stock goes through massive, violent price swings internally. Active traders target those exact swings. They trade the post-earnings revenue jumps for companies like Amazon, extracting profit on the double bottom bounces, while the passive investor simply breaks even. Let's bring the table back up and map out micro-opportunism. The input is actively buying bounces and ruthlessly cutting losses when support fails. The outcome is the ability to generate returns even when the broader market is flat. The trade-off is steep. It demands an exhaustive daily time commitment and carries a severe risk of emotional overtrading. You gain superior capital protection during a market crash, but you transform investing from a passive vehicle into a highly demanding, full-time job. Both of these strategies work, but attempting to blend them during times of high market strengths is the absolute fastest way to destroy your capital. This chart shows the exact anatomy of the hybrid mistake. You enter the market buying in at the peak with a long-term 2027 macro thesis, but when volatility hits, you react to short-term micro data, panic selling at the absolute bottom of the dip. You absorb all the heavy losses of the passive investor while enduring all the chronic stress of the active trader, locking in a permanent financial loss. The market naturally takes money from those who abandon their chosen framework midway through a drawdown. To survive volatility, you must pick one set of rules and intentionally ignore the data meant for the other side. This flowchart provides a clean framework to finalize your approach the next time the market drops 10%. First, check your time constraints. Do you realistically have 4 hours a day to dedicate to monitoring screens and managing risk? If no, you are time poor. Accept the drawdowns, trust the macro thesis, and ignore daily technical warnings entirely. If yes, you move to the risk tolerance filter. Can you stomach a broken trend line and ruthlessly cut losses without freezing up emotionally? If you have both the time and the discipline, you operate actively. Execute strictly on your price levels and disregard long-term media optimism completely. There is no universal right answer to market volatility. There is only the right answer for your specific lifestyle, your emotional control, and the time you have available.